Welcome. You're watching the Mutual Fund Show with me, Tamanna Inamdar. We've had a tough last 5 sessions in the markets. Small cap and mid cap stocks have been badgered. In fact, close to 4.5 to 5% drop in these indices in the last few sessions. Now, why am I talking about that on the Mutual Fund Show? That's because small cap funds and mid cap funds have been the absolute favorite by a long shot for retail investors, for SIP inflows over the last many months. And in the last year or so, you've seen 54% of the inflows going into small cap funds. Is this the time to re-look at those investments? What should be your outlook going forward? Are these funds really performing as well? To speak on this, I'm joined today by Prableen Bajpai, founder of FinFix Research and Analytics. Hemant Rustagi, CEO of Wiseinvest, also joins me on the show. Welcome to both of you, and thank you so much for speaking with us on the show today. Prableen, let me just get your overall view. Is there a bit of panic, a sense of panic that typically follows these phases of correction in the markets when it comes to mutual fund investors and retail investors?
Good afternoon, Tamanna. Great to be here. So I think when the mid cap and small cap and large cap indices, all three have gone up year to date, we've seen a decent movement in the large cap index, and of course a phenomenal about more than four times movement in the mid cap and the small cap segment. And when you see a little correction, I think a lot of investors who are who've been in the markets, who've seen how the markets move, are actually excited to take this as an opportunity and in fact increase allocations. At the same time, for newer investors, yes, I think the concerns are there that, we've just started and the investments start looking bad, somebody who started a month or two back. So I think it's a mixed reaction. But Tamanna, definitely, if I think the macros look good, if fundamentally, there are no issues, then any sort of a broader market correction, I think is an opportunity. And a lot of investors have started to understand that, especially investors who are doing investments via staggered modes such as STP and SIPs. So yes, everybody looks at their portfolios, feels bad that, yes, there is a bit of red, but I till now haven't witnessed much of a panic, at least coming in from our investors.
The concern though is, and let me take this question to Hemant. Hemant, of course, I want your overview on, the kind of reactions which we're expecting to see with the pummeling in small cap and mid cap stocks. And one of the reasons for that is a sense that maybe valuations have gone up. The fundamentals of this space is being looked at. The companies are being looked at more closely. Do you see an impact of that? Because that sort of generic advice is always there, that in the long term, everything will be fine. But how long is that long term is the question.
No, Tamanna, I think since we're talking about these two segments, specifically mid and small, we know that they tend to be more volatile than large caps. But obviously, in the long run, they also have the potential to deliver better return than what large caps can deliver. And when I'm talking about large cap, it's obviously relative to one's own time horizon. So my view is that anyone who has been investing in these two segments in a proper proportion, now that proportion, obviously, there can be a thumb rule. But if you've been looking at your own risk profile or time horizon, I don't think really investors need to worry about the recent volatility that is there, especially in these two segments. And the reason for that is that we have seen that time and again, you will see the volatility for different reasons. It's a natural phenomenon. Every equity investor has to deal with it. So if you're investing in these two segments for a longer duration, now you mentioned about how long is the long term. I mean, honestly, if I'm someone who's investing for my children education or for my own retirement, which could be maybe 10, 15, 20 years away, and I'm very sure about the allocation that I made to these two segments, and I'm investing through SIP, I don't think really I need to worry about it. The problem is when you as an investor try to do what your fund manager is supposed to do. For example, you talked about the valuations, but that's the job of the fund manager to see as to where the valuations are high and where the valuations are looking good, make changes in the portfolio. That's why the money is entrusted to the fund manager. For me as an investor, I need to really focus on how much is my money being allocated to these two segments. And like I mentioned, as long as I'm investing in a disciplined manner with a clearly defined time horizon, I don't think any investor need to really worry about it.
Since you since you just mentioned that it is the fund manager's job, you're right, it is. Are they doing a good job then is the question. And we just pulled out this data. Small cap funds, the average NAV year to date was up 22%. If I compare that with, say, the SME 100, that had a return of about 30%. For mid-cap funds, the average NAV was up 18% year to date, and the index performed about 24%. Of course, these are averages, and some funds would have been superior, some may not have. What is the best option? Probably just taking forward from what you said, that a lot of seasoned investors now realize that these dips are opportunities. How should you go about that? What are the options you should look at? And are ETFs also a good option here then?
So within the mid caps and small caps, Tamanna, I feel that for mid caps, actually taking the index route is a decent choice. So because there is in fact a huge divergence between the best performers and the worst performers, and it's not just on a year-to-date basis. Date basis. If you see 5-year returns, 10-year returns, 7-year returns, there is always a 10 to 15% difference as well in the best and worst performers. So for investors who can actually choose a decent fund for themselves or have somebody to guide them with it, definitely, you continue with your investments or take, if you don't have the mid cap or the small cap segment, depending on the risk appetite, just like Hemant ji mentioned, that if your risk appetite, and the combination portfolio that you have, they must be in sync. So if that is the case, then definitely you can increase a bit of allocation if there is still scope. Otherwise, you continue with the investments. And for those who are looking for a newer investment now, ETFs, are only a different mode of investing in equities. And I feel for retail investors, index funds can actually do the job. But within the small cap segment, I think there is still a decent scope for alpha generation by the small cap fund managers. And I think we are still slightly away from pure passive strategies, though already we do have a micro cap index also available to the investors, which is the 500 first to the 750th, companies allocation we get. So I think within mid caps, index can be picked along with an active fund, depending on what their situation is. And I think within the small caps, an active fund, but both have to be a staggered approach, Tamanna. Investors fall in for the recency buyers. They want to make those returns, 70-80% returns very, very quickly. What we've seen, the microcap index is up 70% year to date.
Yeah.
So I think a staggered approach and the patience is so important overall.
No, so we'll come to that approach in just a bit on what exactly that approach should be. But I just want to talk about what's been happening, just for some context setting here. And Hemant, let me come to you on that. The volume of inflows in small cap, mid-cap, micro-cap funds, and that realization that there is great opportunity here is clearly grown. We've had in the last few months a slew of AMCs that have said no more lump sum investments. They've got too much cash sitting with them, and they're wondering what to do with it. Put that into context with us, for us, Hemant, that has the appetite sort of outgrown the opportunity, or is there much more left?
No, Tamanna, I think there are a couple of important aspects we need to see. One is that before this rally began in mid-cap and small cap, where was the action? The action was more in the large caps. So obviously, in those kind of situations, the more allocation was going into flexi cap or maybe large cap. Second, you just mentioned about some of the fund houses have stopped taking lump sum money in the small cap specifically, not in the mid cap. But I think there are a couple of funds that stopped kind of inflows or the lump sum money almost 1.5 years back. So again, I think every fund manager has been looking at it with a different perspective. From investors' point of view, like I mentioned earlier, I'll go back to that if in the past your allocation to these two segments, because let's not forget that these two segments are very important in any equity portfolio. As I mentioned earlier, I think both these segments have the potential to deliver higher return. And what we're seeing also is that not many investors are now going directly into the large cap. They're all actually opting for flexi cap because there is some flexibility of having some allocation to mid and small cap. So clearly, as long as an investor, if you felt that there was kind of exposure to these two segments were not as much as it should have been, and you've been increasing that, or even for a new investor, again, if you're allocating money to these two segments in line with your risk profile, I think there is no issue at all. every fund house has been taking money from SIP. That's what I said, that through SIP, with a clearly defined time horizon, you can definitely continue. And there will be, this volatility will end after some time, maybe. You will see volatility again. That's something which is going to happen time and again. So I don't think investors need to really focus too much on that.
Let me just take that question to Prableen as well. And the point was that appetite versus opportunity. How do you see that setting in? Clearly, investors are looking at the space. They have that risk appetite. But are fund managers deploying their capital in an efficient enough manner? Are there enough ideas out there?
Absolutely, Tamanna, the first part of your question, the alignment of your risk appetite. And if actually investors do have the risk appetite, I feel that there will be 50% of them who have also fallen in for the trap where they don't look at the past returns and start investing. Because, making money in the stock markets involves a lot of patience, and it's a long-term sort of time period that you have to give. And it's very, very important. If we just look at from 2016, how the Nifty 50, Midcap 50, 150 and 250 indices have worked. Since 2016, they were up for 2 years. Let's take the small cap index. It was up in 2016 and 17. It fell very badly in 2018 and 19. Down by 26 and 10% when Nifty was doing perfectly fine. It was up in 20 and 21. 22 again, it was down by 3.65%. And of course, we've seen a decent rally, 25% this year. So with small caps, especially, it will not be that, the returns are coming in a smoother fashion. So investors, if they have parked their money with the, maybe a bit of the greed element as well, I think they'll have to brace for a longer time period that they have to stay put to actually reap the returns from the segment. And as far as the deployments are concerned, I think what was happening is that too much money was coming in too soon within these two segments. And I think it was only, to enhance the experience of the existing investors and the new investors that, the wrong allocations are not taken by fund managers. They wanted the time. That is what we, as an insight, got when we spoke to fund houses, that they're looking at the right opportunity to, make those additional investments. And a lot of them were even holding cash. And they do have the option, beyond 65%, Tamanna, they can definitely move into mid and large cap as well. So 65% is the minimum that they need to keep for a small cap in the small cap and for the mid cap in the respective market segments. So, and I think now maybe they would actually get that opportunity where they can pick companies of, their choice. And I think if you look at, from the last 5-7 years, the size of the mid caps and the small cap companies has gone up phenomenally.
Right.
So small caps are not those tiny as what they used to be. So is the case in the mid caps.
No, absolutely. That's a fair point. You talked, I'm just going to do a follow-up with Prableen. You talked about being nimble and you talked about the greed factor. So with that greed factor, of course, comes higher risks. Is this the time to be a little nimble? Or should this be a sort of shut your eyes, trust the process kind of an approach?
I think for a retail investor, you have to go with the process, Tamanna, because let's say, even if you take a higher allocation, how big is it going to be? You have to, I think, goal setting and investing for your financial goals and achievement of those financial goals is the primary motive for majority of the retail investors. And I think that is the best way to invest, because you know, this is my time horizon, this is where I want to reach. And that automatically sort of sets your risk appetite also if you're not very sure about it. So I think going and trusting the process is much more important. And the journey in equities is never linear. It will be non-linear, and you have to, I think, brace for those, ups and downs which are going to be there in the markets. So, but yes, any opportunity, I think, let's say a 4% or a 5% fall further from here, definitely a bit of a switch can be done into the segment which you like.
What would you advise, Hemant? Shut your eyes and trust the process, or a bit of a wait and watch right now? Because I don't think anyone's in a position to say that most of the volatility is behind us.
No, I agree with you. Like I mentioned earlier, I think we've seen the volatility now. We'll see the volatility even in future for different reasons. But I think there are two ways how the retail investors are taking exposure to these two segments. One is to invest in funds which are investing exclusively in each of these segments. And the second is there are different categories of fund like large and mid cap and the multi cap. The multi cap invests minimum 25% in each of the segment, and the remaining 25% it's at the discretion of the fund manager where he or she sees the opportunity. So I think a lot of investors have been taking exposure to these segments through these two funds. Now what happens there is that there is an automatic rebalancing that happens from the fund manager. It becomes very difficult or can be tedious for a retail investor to invest in funds which are exclusively investing in each segment and then looking to rebalance it or even reallocate some more money whenever the opportunity arises. But I think when you're investing through the combination of these two category of fund that I mentioned, there is a rebalancing which is happening from the fund manager side. Yes, if you feel that there is time that you need to allocate more to equity, automatically the money goes into a different segment. So I think that is a better approach. It's a more practical approach for retail investor rather than trying to kind of time it to perfection in terms of rebalancing it in terms of exposure to different market segments.
Now, having said that, the fact of the matter is that small cap funds and mid cap funds have performed well. There is a lot of excitement about it. So let's get some picks of their best performing funds or their favorites from our experts on this show today. Prableen, we'll go with you first.
So in the mid caps, Tamanna, like I mentioned, I like the index strategy as well. It is great for investors who have a real long time, view because the divergence is really huge within the mid caps as well in terms of returns. And I think the scope for outperformance is gradually reducing. So the Nifty Mid Cap 150 Index Fund can be a good choice. It's available through 4-5 fund houses. Within the active space, I like SBI Mid Cap and I like Mirai as well. And within the small caps, I think Tata and Nippon, I think these two are decent strategies, but it comes with a disclaimer that investors must do their own due diligence. So it's not an advice to just directly go and invest.
Absolutely. That we should say is a standard sort of caution note. You must do your due diligence, even though, of course, these experts are giving you their view, but check with your own personal finance advisor, do all of that math before you deploy your money. What would you say, Hemant?
Well, Tamanna, if you're looking at basically actively managed fund in both these segments, of course, there is an option always to, kind of have a combination of index and the active fund. But my recommendation, as far as the actively managed mid-cap funds are concerned, the three funds that I would, like to recommend is Motilal Oswal Mid-Cap Fund, HDFC Mid-Cap Opportunity Fund, and Kotak Emerging Equity. And in the small cap space, Nippon India Small Cap, Quant Small Cap, and HDFC Small Cap.
All right. So that was the advice with the usual disclaimers that you must do your own due diligence, do your own homework before you go in and put in your money. But I think safe to say, and last word here, that mid-cap and small cap are going to continue to be flavor of the season for the rest of the year. Hemant?
Well, I think so. I definitely think so because like I mentioned, both these segments have the potential to deliver a good return. Yeah. And as long as investors know in what proportion they have it, as per the risk profile, I think they will continue to put money, and we will see that with maybe higher volatility, but I'm sure they will continue to go up.
What is the apt proportion in your view, Prableen?
So if you look at somebody who has a 10-year horizon, at least, Tamanna, then I feel that with a slightly higher risk appetite, I think your core has to be large in mid caps. So if you're just dividing between the three, then I would say it's about 40% large cap and 40% mid, and I would give 20% to small caps.
Okay. Thank you so much, Hemant and Prableen, for joining us on the show today. And thank you to all of your viewers who have tuned in today. Of course, for more on the mutual fund industry and all the top business stories, do go to our website. Thank you for watching.